Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site is Elias Erickson, portfolio manager at 91. We have Guilherme Valle, founding partner and portfolio manager at ABS Global Investments, as well as David Souccar, senior portfolio manager at Vontobel. And we're here to discuss why investors are increasingly expressing interest in international equities and what fundamentals make them attractive. Gentlemen, it is great to have you with us. Welcome to Trade Talks. Elias, when we think about the macro backdrop, certainly the conversation looks different than it did a year ago.
It does, yeah. 70 days ago even, there was euphoria in the United States and there was depression outside, and that has sort of flipped over just 70 days. Angst about upcoming U.S. tariff agendas, and also how the EU would respond, and tit for tat, and a better prepared China, for example. And so much of the narrative 70, 80 days ago even has flipped, and so the dynamics are very different.
Yeah,
much more supportive internationally.
Right. Well, I mean, you could also make the argument too, prior to the uncertainty that we're seeing in the U.S. market, there was interest in EU and EM because the valuations were attractive too.
Mm-hmm. Oh, they remain very attractive, right? I think the question is that up until the new administration took over, there was like peak fear, right? So we knew all the negative news about China, so everything, I mean, it was like consensus negative. And what you see now is that, I mean, let's see what's happening tomorrow, right? Still kind of the biggest question mark we have is going to be what's coming out from Rose Garden tomorrow. But I think that the valuations remain extremely attractive for emerging markets, and the growth is still there, right?
Yeah, I think it's important to recognize, David, as well, investors have typically stayed within the U.S., right? Especially when you think about benchmarks and so forth. Why do you think they're starting to, become more interested in international equities?
I think I would refer to the point that Elias made. I think two important pillars of what the U.S. stood about, which is predictability, the rule of law, and also the role of the U.S. as the global police of the world to bring stability in the geopolitical side. Those two pillars have been challenged. And the U.S. has benefited from those two pillars by having the dollar as the reserve currency. And that's in question. You saw now the gold is reaching all-time highs. So I think that people start to question, maybe the U.S. is not as safe as I thought. And they start to realize, by the way, there are some great companies in emerging markets, in developed markets, and I can get the same type of returns and diversify my risks.
Right. Well, I mean, Elias, all we've heard about is the Mag 7.
Yeah.
Right? I mean, that's been the narrative. And, again, with the weightings that they have in these indexes, portfolio managers had to be benched to them. So now there's opportunities to look elsewhere.
Yeah, that's absolutely right. And as long as that long trade had been working, people, despite increased interest in international equities, were reticent to make the trade, right? You don't want to look dumb by moving too early. But if you look at the number of shares, liquid shares that have market caps of 3 billion or more, that trade more than 20 million a day, so institutional ready shares, there were 1,300 that outperformed the S&P last year, and 55% of those, 700 of those, were international equities. So, to David's point, it's an alpha-rich environment, and the diversification benefits are obvious.
Yeah, well, I would also, make the argument as well, to your point before, maybe we'll learn something tomorrow, April 2nd. We still have 3 years and 10 months to go. Perhaps this tariff tactic is something that will, be perpetual throughout this administration.
I think the noise will be with us, right? I think volatility will be with us. But I think what is important to understand about emerging markets is that everybody thinks about emerging markets as one place and one asset class. You're talking about 24 countries, at least as defined by MSCI, with over 15,000 securities, trading over $100 million or having over $100 million in market cap. So it's a vast universe, each one with different dynamics, so they can still thrive. I think the main attraction for emerging markets is the expansion of middle class. So these are around domestic themes, right? And yes, maybe the talk about tariffs will create temporary headwinds, but it's not going to derail what's happening in terms of reforms, in terms of demographics, and all these positive attributes that you see across all the countries.
The crazy paradox for me is it would always be there's geopolitical risk when you invest in emerging markets. Well, domestically here in the U.S., David, you can make that argument now.
Yes, sometimes I'm from Brazil. Sometimes the U.S. is now feeling like it's in Brazil. You don't know what's going to be the next legislation that's coming along. Think about if you are a CEO of a company that's going to invest in a long life asset, you're going to build a plant. What do you do now? Do you invest in the US? Do you invest in emerging markets? Because if we invest now This plan is going to be in operation for 10 years, but the tariffs, as you said, maybe will be over in 4 years. So what I'm hearing from the CEOs all over the world is that they are sitting on their hands. They're doing nothing. Yeah. And that's bad for growth.
Yeah, well, I mean, the whole thing is, too, when you think about onshoring, it's not like you just pick up a manufacturing plant and you put it onshore here. I mean, one, it's just physically not possible.
Yeah.
Then you have, labor force and cost and all that goes along with it as well.
Right. It not only it's difficult to do, it doesn't make sense. The US has 300 million people, the world has 6 billion people. Are you going to produce everything in the US? You're going to create inflation. It's inefficient.
Yeah, I mean, even when you think about it too, when it comes to onshoring, there are a lot of Americans that work for international companies, right? So the impact's going to be felt somewhere in addition to the cost.
Yeah. Well, all of these dynamics, I think, highlight that predicting the outcome of what Trump will do, what the repercussions from the international players will be, it's very difficult to predict. Some of them are binary, some of them are multifaceted logic games. And so finding businesses that will have the ability to be somewhat anti-fragile or protected from these dynamics and continue to expand into opportunities that are attractive and accretive to their returns, maybe that's the right way to approach what is such a volatile space.
Right. What about the macroeconomics in terms of monetary policy? What's happening in the EU? How does that compare to what you're seeing here?
Well, in the United States, we still have a wait-and-see policy, right? But in Europe, we have a more dovish policy where they're looking to ease and stimulate growth. And you also have fiscal measures being led out by Germany, where they're looking to invest or create capacity to invest of $1 billion or more. And so you have growth stimulative measures that are taking place in Europe, and then in the United States, we're still looking if inflation has come down enough before we start to stimulate. And so you have a more supportive backdrop outside of the United States in many respects.
Yeah. So, Guy, when you're thinking about where to find opportunities, whether it's regional or sector, how are you approaching this at ABS?
Again, we have 24 countries, 15,000 securities, and again, you may have countries that are facing headwinds right now, right, with the tariffs or for idiosyncratic reasons like Brazil, for instance. But we still see, for instance, India remains very attractive, is expensive. China is very attractive, like in terms of valuations, but you have to deal with other type of risks, right? So again, for me, the most important thing is that for the first time since 2009, you see an opportunity for some decoupling between international markets in general, emerging markets in special, and the US, right? Because from 2009 onwards, with the advent of QE, you can see that US embarked on a very strong ride for the markets, while the rest of the world pretty much lagged, right? Yeah. So I think now we have a chance to start looking for value outside of the US.
Yeah. Or, David, when you think about it from a sector perspective and you're looking in the EU or in other regions, is it very tech-driven, consumer-driven? What sectors look attractive? What are you looking for? What would you potentially avoid?
Yeah, I think you made a good point. The whole point of investing international is not necessarily because the macro international is much better. The US, they have their own problems, but it's the breadth and the depth of opportunities that you find. And you find them in technology, like SAP. You find in defense, like Rheinmetall. You find in consumer goods, like Hermes. So there is a wide range of companies that are quality. They have similar operating metrics to the best US companies. And they have in the past have outperformed or have similar performance to the US market.
Yeah, I mean, Elias, you could see it in what happened with EU defense tech as an example. I mean, the inflows there were quite remarkable, going into the defense ETFs as an example.
Well, absolutely. So because of shifts in the geopolitical environment and the willingness of the United States will trump to continue to fund the NATO budget as it's been. It's forced an awakening amongst the EU counterpart to make up what has been more than 30, 40 years of collecting the peace dividend. And so there's a large amount of money that's being earmarked for defense spending and defense catch-up spending, and that's a multi-year, if not decade-plus type rebuild effort, which can stimulate that sector of the economy, but also have echo effects that could go into other industrials as well.
And the interesting thing about defense is not like tariffs is going to be over in 4 years. There was a break in confidence between the United States and the rest of the world. That's going to stay permanently, I think. Yeah. The need for the allies of the US, Europe, Japan, Australia, to become self-reliant in defense.
Yeah, well, I mean, back to your point, though, Elias, when you're talking about derivative plays off of the defense sector, the way that the calculus of warfare has changed as well. So you start thinking of cybersecurity, you start thinking of some of the emerging technology plays, such as AI as an example. So there are a lot of derivative plays because the landscape, the attack sectors the attack vectors have just changed so much, even compared to 15, 20 years ago. And by the way, when you build, let's call it a plane or a helicopter, they take 10, 15 years to build, right? But this technology is evolving. Every 6 months we're looking at something new, if not faster, right?
Yeah, and again, if you just take AI as an example, right? And the belief is that, okay, China was, I don't know, 3, 4, 5 years behind the US, and then suddenly you have DeepSeek, right? The same thing you see there, you see in electric vehicles, but also you can extrapolate that to defense, right? So, so it's something that, I mean, the pace of change it's so fast, and again, everything needs to be adapted in a much quicker way than before. And if you understand on a global landscape, it's much more than just having a simple view coming from the U.S.
So I would imagine, from a portfolio management perspective, these are actively managed strategies, especially when you're looking at tens of thousands of stocks?
15,000, yes.
Yeah.
So yes, definitely active. And our approach is to actually partner with local groups on each country, and having each of these teams with the simple goal of outperforming their local benchmark.
Right, and especially there's the nuances.
Yes.
Are very different from, we tend to think of it in the United States, going from New York to New Jersey or, to California isn't a big lift. I mean, we take it for granted, we don't think about it, but, going from Eastern Europe to Western Europe is a completely different culture.
Just think like emerging market, in which type of grouping of countries you can have South Korea and Peru in the same group. I mean, there's absolutely nothing in common. So it's really hard to have the same mindset to look at stocks in these two different markets.
Right, especially when you're dealing with multiple economies and multiple monetary policies and multiple political regimes. And I'm trying to wrap my head around that. That can be a challenge.
Yeah, so our approach is to simplify these complexities by looking company by company. And we have an approach that we call quality investing. So we find great companies, they have a good track record, have high margins, high returns. So they are not as susceptible to all the complexity in the macroeconomy.
Yeah, well, I mean, if we look ahead a little bit here, to be fair, companies in the U.S., the fundamentals have been quite strong, and they have operated well, particularly in the past 5 years with COVID and different technology migration shifts and so forth. So once we get to the other side, there could potentially be opportunities from an investing perspective.
Yeah, I think that there absolutely are opportunities. I think most investors that are in the United States have been taking advantage of the strength that is in the S&P 500 index. They've been passive, maybe unbeknownst to them, but they have roughly 30% of their portfolios that's invested in technology. And so it's a more active bet than it ever used to be. But in that trade, if you look to diversify internationally to EM or developed markets, you are going to look from a passive to a passive perspective at a downgrade to the portfolio fundamentals that ultimately drive earnings. So in the US, we have higher returns, we have less debt, we have stronger projected long-term earnings growth. When you move to a passive approach because of the sectoral composition of the international indices, there's an inherent downgrade. And so that's why, especially outside of the United States, an active approach helps you to maintain exposure to those dynamics, those fundamentals that will drive outperformance. And as a fundamental investor, I believe that earnings ultimately drive share price performances. So you want to maintain that fundamental exposure that's attractive, but you want to take advantage of the alpha, take advantage of the diversification when you do it.
And I think one of the misconceptions American investors have is that when they invest in the S&P, they're investing in the U.S. economy. 40% of the earnings from the S&P come from the outside. One of Apple's largest markets is China.
Great point.
So when you invest in S&P, you are already an international investor. The question is, do you have the best portfolio? Do you have the best international companies? Are you diversified enough? It's not about investing in the U.S. or not. It's about having a great portfolio.
But so interesting too, because if you look at the composition of the sectors and how the weightings have changed in the S&P as an example, because we're talking about risk concentration, it's a Max 7 that's performing and so forth. Well, energy and financials had a bigger weighting, let's call it 20 years ago, than technology does, right? So that risk concentration, to your point about passive investing, Guy, it does exist in what you'd consider more broader indexes.
Yes, absolutely. Listen, it's always going to be challenging to construct indices, right, and to invest based on those indices, but they reflect the opportunity set, right? So the same way that you see the Mag 7 happen in the US, it's possible that we're going to see the first move to international markets maybe driven by index investors, because you have so many investors that are underweighted international markets, EM or developed, that you may see that first move going to some of the heavyweights, right? So if you take China, for instance, instead of trying to find the most exciting stocks in China, maybe the first dollars will go to Alibaba and Tencent and some other
like their
very
Mag
heavyweight.
7 versions of those.
Exactly. So you may have that in the first move, and then after, people start realizing, okay, there is more value around those names, right?
Yeah.
We're seeing that in developed markets. The best performing sector right now, European banks. Yeah. And you think that without the uncertainty, that's not where people want to put the money, but I think it's just basically the flow going passive, and that they happen to be the largest cap.
Yeah.
But that creates an opportunity also.
Yes.
It does too, and I feel like especially in the U.S. we're always looking for, the next big thing. So this seems, a bit obvious to try and extrapolate what these data points are, and finding that next NVIDIA,
yes,
if you will. But I think it's interesting what you brought up before. There is so much international exposure with those companies, indexed in the S&P, as an example, even the Nasdaq 100, right? Our flagship index. I would imagine, I would argue that probably the international revenue from there is even a little bit higher.
Yeah, well, so the point would be, let's say you're a very US focused investor. If you want to have a fulsome exposure to the US market, you have to, by default, own international businesses that comprise a significant portion of the US economy. If you take a more called value chain perspective around what is exciting, what's coming next, and AI, just take that as a theme, that AI value chain includes companies like ASML, based out of Europe, that produces the lithography machine that make the chips. You have Samsung that produces memory. You have TSMC, which has the lion's share of the high-end condensed chips that are in all of our cell phones and our laptops. And so that's an international component of a value chain that we think of as AI as a very US theme, but DeepSeek and others. But it's a very broad opportunity set, and you get inherent diversity outside of that very focused US risk.
Yeah.
And the beauty of international is not concentrated in 7 stocks. So let's take, for instance, the largest tech company international, TSMC, 3% of the index. Apple is 6. So as an international manager, you actually can differentiate versus the benchmark without taking too much risk. And that's explained why historically international active managers have generated more alpha than US active management.
Yeah, I mean, think about it too, with the Mag 7, it was somewhat of an anomaly. You don't get that kind of stock performance, even though, US equities, past couple of years, have been up 25% year over year. That's an anomaly. That's why the averages are called 70%.
And I think probably that's one of the key points, is that, listen, the US still have a very vibrant economy, still fantastic, but the question is how the market became so narrow and valuation so high. So I think now it just opens people's eyes to look outside and see that there's definitely a lot of opportunities outside of that, right?
All right, we will leave it on a positive note. Appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.